Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, December 3rd. I had great plans to have some nice charts for you today. There was some good action this week, and we just got buried on the trading desk. Markets were very fluid this week, especially the back half of the week. And if you just look at the indexes, say the Dow down 1% on the week, or the NASDAQ down 2.5%, S&P down 2 and change on the week, you don't get a full picture for some of the churn and volatility going on in these markets. They're specific to certain types of stocks. We call them story stocks, stocks that are out 12, 24, 36 months away from profitability but are showing good growth. There are certain areas that really got hammered, and many of these are connected still to the COVID run of 2020 into the first half of 2021, and we've discussed them. The names that pop up constantly, and I got 3 emails the last 2 days from clients and friends asking me about the ARK funds. We discussed the ARK funds on here last spring and summer. Very concentrated ETF family, very concentrated. At one point last year, and I don't follow them close enough month to month, but at one point last year, they owned 25 different companies in which they owned 10% of the outstanding shares. Wow. Talk about risk in terms of needing those names to perform. Because if you start to get poor performance and liquidation starts to creep in, you're really stuck in a really tight spot. And you're seeing it right now. What happens is when you get a large ETF family or mutual fund family, or even, think back 12, 13 years ago to Bear Stearns and Lehman. This is nothing of that nature, not even close, and I'm not suggesting that. But what my point is when you get a mass liquidation going on, a mini bomb go off, you get ripples throughout the market. And you're feeling those ripples in areas that aren't specifically in that story stock realm. And you saw it today, right? You saw pressure on the Microsofts. You saw Adobe. Adobe got taken to the woodshed today off of a DocuSign miss yesterday. Whether that continues, be interesting to see. But what we tend to see is when some of the really strong names, strong balance sheet names, 30% growers, 25% growers, get taken out. We tend to be closer to a little bottoming action in the market. I don't know if that's 1 day, 2 days, 5 days, a month. But on those type names, you have valuations to lean against. On some of the others, some of the ones we mentioned, the story stocks, there's no valuation to lean against. So there you're just going to trade on a oversold, pure fear, from a pure fear standpoint. If you want to trade in those names, there's really not a valuation to be made there. But you will get to the point where enough of that stock, and I'll use a term that's common on a trading floor, enough of that stock gets puked out that you can get a little rally. We'll see when that is. That may take some pressure off of the rest of that growth complex, which is primarily the NASDAQ, which is struggling some. So what did we do this week? US ETF. We added banks. We'd been underweight financials. They had a nice run. As rates fell, financials fell. Remember, we talked about trying to break that pattern. Haven't broken it yet. The 10-year, by the way, traded at 135 today. I don't know where it closed. But keep in mind, it was 170 a month ago. So as rates have come down, financials have come down. Came down to an area we wanted to be a buyer in US ETF. So we bought XLF. We've got a 7% position in there now. That's a basket of banks, broker-dealers, credit card companies like Visa and MasterCard. So we're comfortable there. tried to take advantage of that pullback. What else did we buy? In US ETF, we initiated a position in electric batteries. Been red hot, been a spot to be really for the last couple of years, but can be volatile. So you'll see if you're in the US ETF strategy, LIT, which stands for lithium, which is a major ingredient, major material in electric batteries. US core strategy. We added a 5% position in an ETF I'm a big fan of. It's First Trust Capital Strength ETF, FTCS. We had a 15% position to begin with. Added another 5, took that to 20. Keep in mind, in core, we're not making industry and sector calls. We're broad, index type calls. So we took advantage of that, I hope, this afternoon. And the reason I say I hope, you never know if you took advantage of it until you see where it trades. What a pet peeve of mine has always been, you buy something and you think the price is good and someone will say to you, hey, that was a good buy. You don't know it's a good buy until that trade is closed. Those aren't your profits until that trade is closed. So we'll see how these buys work out. The Moose is on, talking about bond market rip in treasuries. Remember, prices up as yields down. We'll see what next week brings. Again, feel free to reach out through email with any questions, any comments. If you want to share some thoughts and ideas, feel free. You can also, again, feel free to ask us questions. We'll try to address them, 1 or 2 questions a week on the video. In terms of the survey, that's something we got back, that viewers had questions and could they ask? Certainly, and I'll try to address them a couple a week. So everyone have a great weekend. Strap in. I think next week we'll have more volatility when the VIX gets through 30 like it did. That tends to warn us that the next 30-day snapshot, which is what the VIX is taking a look at, probably has a good dose of continued volatility. Have a great weekend.
Hi, it's John Mousseau. I'm the CEO of Cumberland Advisors. It is Friday morning on December 3rd. Story this week, the employment report this morning. Job creation, a little disappointing, up 210,000 when the number for expectations was more like 500,000. But there was a lot to like in this jobs report. Number one, you saw the unemployment rate go from 4.6 down to 4.2. That by itself is a good sign. Even better signs. The uptick in the labor participation rate from 61.6 to 61.8, also very good. As you dig further in, some very good signs. Unemployment, black unemployment down from 7.9 to 6.7, Hispanic unemployment down from 5.9 to 5.2. This is a sign that the economy is really working its way back. The bond market, really a tale of two cities here this week. 10-year and 30-year bond yields on treasuries down about, call it 5 and 6 basis points to a 143 and a 175 respectively. Long-term munis 10s and 30s were down about 3 basis points for the week. The real telling sign is in a week where you had Chairman Powell speaking before the Senate Banking Committee and the House Financial Services Committee. And remember, he's doing this after he's been nominated by the president to serve another term as chairman of the Federal Reserve. He parried a lot of questions very well. And I think what you got out of it was the chairman saying, hey, inflation is a concern of ours. You don't hear the word transitory anymore. And we are somewhat concerned about it. So even though you saw longer term yields come down with maybe some concern over the new Omicron variant of the virus, the story, when you look at the 2-year note, which we have here a graph of, went up 10 basis points this week. And it tells you that the markets are expecting the Fed to start hiking next year. Clearly, they would like to hike into an interest rate environment that's a little higher than it is now. You're going to start to see them taper back their purchases. We know that they started that in November, cutting back on the number of treasuries and the number of mortgage-backed securities that they're buying. We think that they accelerate that as you get into the new year, particularly if we don't get really hit hard by the new variant. We think they will pick that up. And really, it's a continuing story of getting out of Zoom and into the room. And we think that's an important theme that continues to move forward. So with that, we wish everybody having a great weekend, and hopefully everyone's having a great holiday season, and we'll talk to you next week. Thanks.